Many renters policy owners assume that their policies are properly written. How do you actually know whether your policy is written correctly and whether you're actually covered for everything that you're supposed to be covered for? When was the last time anybody went over your renter's policy with you? Hi, I'm Paige Tofighi, CEO of ArcLight Insurance Agency, and today we're going to go through an actual renter's policy where we go over the coverages and I describe some potential pitfalls that I think you should be aware of. First, I think it's important for us to discuss what a renter's policy is and who might need it. Renter's policies are different than, say, a typical homeowner's policy in that it is meant for people that are renting a property that don't own the structure that they're living in. So someone that's renting a house or someone that's renting an apartment or a condo, etc. Renters policies cover consumers for two major things. Number one is their personal property. Number two is their liability. First, let's talk about personal property coverage. What is personal property and how should you evaluate how much coverage to have? Personal property is basically your contents, what you were to move in with or you would take with you if you moved out. There was a saying that if you take the structure that you live in and you turn it upside down and you shake it like this and everything that would fall on the ceiling, that's your personal property. The personal property valuation should be very specific and deliberate. Let me explain what I mean. Most of us buy furniture, buy clothing, buy electronics, whatever the case is, at specific times of year, maybe when they're on sale, maybe on Black Friday, I decided to buy this, 100-inch TV that was 50% off, whatever the case might be, right? So the majority of things that most consumers buy, they buy at random times. Maybe they saw a sale somewhere or what have you. So when we're evaluating personal property, it's very important to first identify what we have, right? Take an inventory of clothing, how many pairs of this, how many pairs of that, couch, electronics, etc., and then determine the market value of these things, right? So if I have 3 pairs of jeans, I need to be able to identify that I have 3 pairs and have an associated cost with those. The thing about it is that if you're ever in a position where you experience a loss, let's say, heaven forbid, there's a fire and the entire structure burns to the ground or something, the insurance company's goal is to indemnify you or bring you back to zero as soon as possible. They're not going to be concerned about waiting until this year's Black Friday or waiting for this year's major sale event to be able to get you the same things that you had. They're going to want to get you those things now, right? And so the cost of replacement of your personal property may be significantly higher than what you actually paid for them. So this is an important consideration. A lot of people say, well, listen, my couch, my TV, my clothes, I don't have more than, X amount of coverage. I don't need to have a higher limit or anything like that. But this is where I want you guys to think about, how are you evaluating all of your contents in your apartment or your house or where you live? Think about if you had to replace every single piece of property that you own in that facility today, you'd go out to the store and just get whatever. How much would that cost you, right? That's a good way of looking at it. So let's go through a typical policy here. And, on this policy, we see that we have coverage C, personal property coverage. Personal property coverage, again, is your contents. And on this policy, the coverage for this policy is $29,500. So they're estimating that all of the contents for this person in their home is $29,500, which means that that's the cap, right? If they experience a total loss and they start doing the math and they realize, listen, I actually had $40,000 in contents, the insurance is going to only pay to the maximum amount of your limit. If you notice here, the premium on this one is $204 for the entire year. Okay, so renters policies are actually very affordable. And I would say that if this personal property limit coverage of $29,500 was maybe $40,000, the premium would maybe go up, I don't know, $50, $40, something like that. It's still very negligible. The next thing underneath it, coverage D, is called loss of use. And on this policy in particular, it says 24 months. Loss of use is basically if you experience a situation where your use of your apartment or your house that you're renting is lost because of a covered claim, they will pay for you up to 24 months, whatever the cost is for you to live, up to 24 months until your apartment or the house that you're renting is repaired and you can go back to it, right? And this includes costs for a hotel, for accommodations. Let's say that you don't have clothes now. You have to go buy clothes. Your computer or your phone was also damaged and you need a computer and you need your phone for work. So you have to go buy all of those things again. So that's an important coverage. In section 2 here, we have personal liability, each occurrence, coverage E. And we have medical payments to others at a rate of $1,000. The liability limit is $100,000, and the medical payments is $1,000. Let me talk about liability. Liability is third-party coverage. Okay, third-party coverage means other people. So first party is you, the insured. Second party is the insurance company. Third party is literally anyone else around the world. If you go to a store and you come out to the garage with your cart, if you're grabbing stuff from your cart and putting it in your trunk, and then you turn around and your cart is rolling to the other side, you run after it and it hits the car on the other side of the aisle and it breaks the taillight, hypothetically, okay? If that happened, it would be your liability policy on your renter's policy or your liability policy on your homeowner's policy that would cover you for the damage to the other person's car, right? A lot of people think, well, I have car insurance. Would that cover it? No, because that damage didn't happen in the course of you driving your vehicle. So liability policy is very important for those reasons that I just gave. Medical payments, very common on most insurance policies. You'll see medical payments. And medical payments are usually just to pay someone that may have gotten injured on your premises. I don't know, something that you did, or maybe they're just clumsy, right? The medical payments does not require, the insurance company does not require proof of fault for the insured. They'll pay up to, in this case, $1,000 for whoever may have gotten injured on that property to go and get a chiropractor treatment, go to the emergency room, or just go to a doctor and get seen. That's what medical payments are for. A couple of things that's actually very important below that. Let's look at the included coverages. We see full value on personal property. And I'll explain what that is. And then California workers' compensation coverage. The workers' compensation is very important. Most homeowners and renters policies have this coverage as well. And that covers you for things like if you have a cleaning crew come to your house, you have a housekeeper that comes to your house, cleans every once in a while and goes. If that person gets hurt in the course of their job at your property, this policy will give them some coverage. Full value on personal property, it says included, which means that the personal property is covered at replacement cost. That's full value, meaning that if you experience some sort of a loss of your property, the insurance company will pay whatever it takes to get that replaced with a like, kind, and quality, whatever it was. Okay? So if you have a 65-inch TV and that TV is somehow damaged or lost or otherwise not usable, the insurance company will buy a like, kind, and quality 65-inch TV to replace that. Even if you bought that TV 3 years ago, you paid maybe $2,000 for it. In today's market, if you were going to sell it on Craigslist or you're going to sell it online, you might be able to get $200 for it. That is called actual cash value. Insuring personal property as actual cash value, which is the cost minus depreciation, is lower. The insurance cost is lower because the risk is lower for the insurance company, right? But it's not worth saving literally $10, $20, $30 per year on your policy, in this case for the renters, to not have your property covered at full value. These coverages cover you for damage to your property or have liability protection for you on your, think about it as like an angel on your shoulders, if you will, worldwide for anything that might happen. Basically, if you cause damage on the liability side, if you cause damage, bodily injury or property damage to someone else anywhere in the world, your liability coverage on your renter's policy will cover you for that. Your personal property coverage is also worldwide. Why is that important? Well, if you go on vacation and your luggage is lost, the airline loses your luggage, or someone steals your luggage, or your hotel has a break-in and somebody steals your wedding ring or jewelry or your watch, whatever the case is, these are all covered as long as they are properly scheduled on your policy to begin with. So in this example that we're giving, the personal property coverage is $29,500, right? This could be potentially adequate for the person that this is covering. But there are certain things that I think is important to also dictate about personal property coverage on renters policies and actually homeowners policies as well. They operate the same way. And that is, when they say $29,500 for personal property, there are still some underlying coverages for certain things, right? So for jewelry, silverware, fine china, firearms, there are underlying coverage. What does that mean? So if I have a $29,500 total personal property coverage, my underlying jewelry limit might be $1,500. And that means that the insurance policy is not going to pay for any jewelry theft or loss or damage more than $1,500. And some policies even have a further restriction which says we will cover up to $1,500 for this policy of jewelry, but no one piece can be more than $1,000. What does that mean? What do I have to do to get my ring covered? What do I have to do to get my jewelry properly covered? This is why we say that for those high value items, they need to be specifically scheduled or named on the policy. So if I have a $5,000 engagement ring, if I have a $15,000 engagement ring, whatever the case might be, I need to get a professional appraisal of that piece. The appraisals that insurance companies require have to be 5 years or newer to evaluate the value of that in today's market. And look, appraisals matter because you might get something appraised today, and then in 3 years from now, the cost of gold or precious metals or diamonds, etc., might be higher. The insurance company cares what the value of that piece is in case there's a loss or theft of that piece. They need to know how much they're going to have to be liable for to replace that item with like, kind, and quality. Sometimes you might have fine art collections, or you're a triathlete or a cyclist and your bicycle alone is worth $10,000 or $15,000 or even more. Sometimes people buy a computer, a MacBook Pro. If you get an M4 MacBook Pro fully loaded, you're spending $7,000, $8,000 for that computer. I always recommend that you should add that to the policy, just list it on there, even though those items are covered in the total personal property replacement value of your policy. Why would you want to schedule those things on your policy if they're already covered anyway? If you experience a total loss, you have to prove and communicate to the insurance company what you had and what the value was. A lot of times people say, if you don't schedule your jewelry, let's say you had a necklace or something, and you didn't schedule it on the policy, and you're like, my necklace was worth only $900 anyway. It's under the limit of coverage for my policy, so I'm okay. That's true. You don't have to worry about scheduling those on the policy, but you have to still show that you owned it. You have to prove. Insurance companies will ask for photos. Hey, show me a photograph of you wearing that necklace. Show me a receipt of where you purchased that and when you purchased it. So if you buy a high value item that's already covered in the replacement value of your personal property, like in my previous example, a very expensive triathlon bicycle, a very expensive laptop, etc. The reason that I recommend for clients to add those to their policy when they get those is very simply so that there's record of it. So if there's a loss later, they don't have to worry about proof of purchase, photos, etc. of that high value items. You're going to have, your receipts. You might have a hard drive of all of your receipts. You might have a scanning thing at your house where you're scanning all your receipts. But what happens if you have a total loss? What if somebody steals your laptop? What if there's a fire and it gets damaged and you don't have access to that data anymore? So that's why I always recommend for high value items to list them, because in doing that, you're actually providing preemptively the proof of purchase, the proof of coverage, and the proof of value to the insurance companies. And this is why I think it's important to have a discussion with agents. I think a lot of times people are afraid to have a very serious and upfront conversation with their agents about, hey, this is what I have, this is what I do, can I do this, can I do that, am I covered for this? You don't know what you don't know. And so having these discussions with your agent will allow them to advise you properly, very simply put. One last thing that I think is important to talk about is most people that have renters policies are, shall I say, required to have a renter's policy. So if you rent an apartment, maybe the management office requires you to have it. If you rent a house from someone, maybe the homeowner is requiring you to have a renter's policy. If you're not obligated to have a renter's policy, you might think that you don't need it. You might think it's not important. I would seriously challenge that just based on the things that we've talked about today. But also another thing that I've noticed that I think is important for most people to consider, and I'm talking to the people that maybe don't have a renter's policy who thought that they don't want to have the additional expense, like I don't have that much of a liability risk, I'm not going to ever have a claim, etc. Think about it this way. If you have an auto policy and you get a renter's policy from the same company that you have your auto policy with, a lot of times the discount that you get on your auto policy can be as much, if not more, than the premium you're paying for the renter's policy. It's called a multi-policy discount. So you have an auto policy and you want to add a renter's policy to it. The discount you get on your auto policy, which could be between 15 and 25% of your auto policy, a lot of times is lower than your renter's policy. So in other words, you're getting the renter's policy basically for free. Thank you for watching another episode of Rest Insured. If you liked the video and found its contents useful, please like the video and subscribe to our channel. If you'd like us to cover other topics in the future, please leave that in the comments below. And visit ArcLightInsurance.com to get a free quote in this line of business and dozens more. Thank you for watching.